In early August 2024, something eerie swept through global markets. Virtually overnight, the Japanese yen, a currency that had been quietly weakening for months, surged in value by over 10% against the US dollar. Stock prices from Tokyo to New York buckled as panicked traders raced to unwind their positions. Billions of dollars in seemingly safe bets unraveled within hours. It was as if an invisible force in finance had suddenly snapped, jolting the world economy. What on earth just happened? The answer lies in a long-standing, little-understood strategy often likened to financial dark matter. Unseen but immensely powerful. It's called the Japanese yen carry trade. For decades, this obscure maneuver quietly pumped cheap money out of Japan and into riskier assets around the globe. It has helped inflate property booms in places like Australia and fueled stock and bond bubbles from New York to Istanbul. Now that invisible force is shuddering. How did a lowly Japanese interest rate become the fuel for global bubbles? What exactly is the yen carry trade? And why does it hold the power to rock economies on multiple continents? And most importantly, what happens if this house of cards comes crashing down? To understand the yen carry trade, we first need to understand why Japan's money became so cheap in the first place. Flash back to the 1980s. Japan's economy was on fire, with its stock market and real estate prices soaring to dizzying heights. This bubble economy eventually burst spectacularly around 1990, plunging Japan into a severe recession. In response, the Bank of Japan, BOJ, slashed interest rates dramatically in the 1990s, trying to spur growth and fight off deflation. By 1999, the BOJ's policy interest rate was effectively zero, the start of Japan's now decades-long experiment with ultra-easy money. For perspective, while US or European interest rates fluctuated over the years, Japan stayed near 0%, even dipping slightly negative to minus 0.1% in 2016. The BOJ kept rates at rock bottom to jumpstart the stalled economy and encourage borrowing. But an unintended side effect was that money in Japan became practically free to borrow. Imagine walking into a Tokyo bank and getting a loan at 0.5% interest. It sounds like a dream. In Japan, for many years, that was close to reality. With few good returns at home, Japanese investors began casting their gaze abroad. By the early 2000s, they faced what one analyst called zero yields at home, so they ploughed trillions of yen into foreign markets in search of better returns. This flood of outbound investment turned Japan into the world's biggest creditor nation. In fact, as of early 2024, Japanese investors held roughly 667 trillion yen in foreign stocks and bonds, about 4.5 trillion USD, more than half of that in overseas bonds and debt assets. These enormous capital outflows from Japan created the perfect conditions for the yen carry trade to thrive. At its heart, the yen carry trade is a straightforward money-making maneuver. The idea is simple: borrow money in a country with very low interest rates, like Japan, and invest that money in a country with higher interest rates. The profit comes from the interest rate differential. If done correctly, it's almost like free money, like borrowing cash at a cheap rate in one place and watching it earn a higher rate somewhere else. This strategy isn't limited to big banks or hedge funds. It's been popular with all sorts of players, from Wall Street traders to multinational companies, and even ordinary individuals funding their mortgages. Let's break down how a typical yen carry trade works in practice. Borrow low-interest yen. A trader first borrows a large sum of Japanese yen at Japan's ultra-low interest rate. Thanks to BOJ policy, yen loans might cost almost nothing in interest. For example, an annual rate around 0.5%. Convert to higher yield currency. The trader immediately converts those yen into a different currency from a country where interest rates are higher. In the 2000s and 2010, favorites included the US dollar, Australian dollar, New Zealand dollar, Turkish lira, Indonesian rupiah, Mexican peso, basically any currency with a juicy yield. Invest for higher return. The funds are then invested in assets denominated in that higher yielding currency. This could be government or corporate bonds, stocks, real estate, or even just deposited in a bank to earn interest. The key is that the target investment might yield, say, 5 to 10% annually, while the cost of the yen loan remains near 0%. For instance, at one point an investor could borrow yen at approximately 0.5% and buy a safe US Treasury bond yielding approximately 5.5%, pocketing an easy 5% profit margin minus hedging costs. Multiply that by millions or billions of dollars, often using leverage, and the carry trade looks very lucrative. Profit, as long as nothing changes. As time goes on, the trader collects the higher interest from the foreign investment and periodically pays the negligible interest on the yen loan, profiting from the difference. If the yen stays weak or depreciates further against the target currency, there's a bonus. When converting back, the borrowed yen are cheaper to repay. This enhances profits even more. In an ideal scenario, the trader eventually converts the foreign assets back into yen at a favorable exchange rate, repays the yen loan, and keeps the profit. It sounds like a money printing machine, and for a while it can be. In fact, annualized returns of 5 to 6% or more have been typical on yen carry trades in recent years, roughly the gap between US and Japanese interest rates. Some yen carry plays have been even more lucrative if the exchange rate moved favorably during the trade. However, there's a catch, and it's a big one. The whole strategy only works if all goes well, as traders like to say. The biggest risk is currency fluctuation. Because the trader eventually must convert foreign currency back to yen to repay the loan, any sharp rise in the yen's value can wipe out the profit margin, or even cause huge losses. In other words, the exchange rate risk looms over every carry trade. If the yen strengthens unexpectedly, the trader will need more of the foreign currency, dollars, lira, etc., to buy back the yen owed, potentially erasing that interest differential gain. Carry traders typically bank on stability. They seek out times of low volatility and predictable central bank policies. That's why Japan's long-standing predictability, years of zero rates and anemic growth, made the yen a favorite funding currency. But if something upsets that stability, the exits can get crowded fast. A veteran Japanese trader once warned, when a crowded trade like the yen carry starts to unwind, everyone tries to get out of the pool at once, and the rush for the exits can be swift and violent. In those moments, the benign carry trade morphs into a stampede, as we'll see in real examples. The yen carry trade isn't just a theoretical concept, it's played out dramatically in real markets. Let's explore a few vivid examples to see how this works and how it sometimes goes terribly wrong. Boom and bust in the Australian dollar. Australia, with its historically higher interest rates and resource-fueled economy, has long been a prime target for yen-funded carry trades. In the early 2000s, many investors borrowed yen at near zero rates and used it to buy Australian dollars and Australian assets. This Aussie carry trade was highly profitable between 2003 and 2007, as the Aussie dollar consistently appreciated against the yen instead of falling as theory might predict. Not only were investors earning higher interest on Australian bonds or deposits, but their Aussie dollars were gaining value relative to the yen, amplifying returns. By mid-2007, these traders were sitting on sizable gains. It looked like a one-way bet, until it wasn't. When the global financial crisis hit in 2008, risk sentiment reversed violently. The Australian dollar plunged in value, falling sharply against the yen. And in a matter of months, it wiped out years of accumulated carry trade profits. What went up came crashing down. Those who had gotten too comfortable were reminded why the carry trade's gains are sometimes described as picking up pennies in front of a steamroller. The Turkish lira temptation. In the 2010s, Japan's proverbial Mrs. Watanabe, a nickname for Japanese retail investors, found a new love: Turkish lira bonds. Turkey's interest rates were very high, for example, around 7% or more on government bonds, at a time when Japan's were near 0%. That interest gap was too delicious for yield-hungry Japanese households to ignore. They poured money into lira-denominated assets, effectively engaging in the carry trade from their living rooms. By 2018, the Turkish lira had become hugely popular with Japanese retail traders. One could borrow yen cheaply and earn a fat yield in lira, boosting returns on personal savings. Many even looked past Turkey's creeping inflation and President Erdogan's unorthodox economic policies because the interest payoff seemed worth the risk. But this story, too, ended in tears. In August 2018, a diplomatic spat between Turkey and the US triggered a colossal sell-off in the lira. The currency plummeted over 13% in just days. Japanese mom-and-pop investors who had been buying the dip on lira suddenly saw their positions collapse in value. Data from Tokyo showed Japanese traders cut their lira holdings by a record amount in one day, scrambling to stop the bleeding. The formerly high-yielding lira had turned into a trap. As one analyst quipped, they had been buying on dips, but the fall was too large to stomach. Many also rushed to dump their other favorite high-yield plays, like the South African rand, which only exacerbated those currency drops. The Turkish saga showed how quickly a carry trade can unravel when an external shock hits a target country, and how the fallout can even roil other markets, like the rand, as investors cut losses. Mortgages and emerging markets. It's not only professional traders or investors benefiting from Japan's cheap money. Over the years, there have been cases of individuals and companies around the world taking out loans in yen to fund projects or purchases at home. For example, in some emerging markets or Eastern European countries, borrowers once obtained yen-denominated or Swiss franc-denominated mortgages because the interest rates were far lower than local currency loans. This is effectively a carry trade in personal finance. You borrow in yen at, say, 1% to fund a house purchase where local mortgages would cost 5%. It works nicely until the yen's value rises. When the yen strengthens, suddenly the amount you owe, in local currency terms, balloons, even if your interest rate was low. Many such borrowers learned the hard way that a cheap yen loan can become very expensive if the exchange rate moves. In fact, even companies in Asia participated historically. During the 1990s, some firms in Thailand, Indonesia, and South Korea borrowed in yen or dollars to capitalize on lower foreign rates. When the Asian financial crisis struck in 1997 and local currencies collapsed, those yen debts became crippling. It was another reminder: the carry trade giveth, and the carry trade taketh away. Each of these examples illustrates a common pattern. The yen carry trade can quietly pump up asset prices and currencies. Australians enjoyed an influx of investment. Turkey enjoyed lots of Japanese buyers for its bonds, creating a sense of stability or even euphoria on the way up. The bubble builds almost imperceptibly, but when conditions change, the reversal can be sudden and severe. We'll now turn to how these flows have contributed to broader asset bubbles and market instability over time. The yen carry trade has been implicated in inflating asset price bubbles across the world during periods of abundant liquidity. When money is essentially free to borrow in Japan, it tends to flow outward and find homes in higher yield or speculative investments abroad. By amplifying global liquidity, the yen carry trade has at times added extra froth to markets already on the rise. Consider the mid-2000s, a period often remembered for various booming markets: US housing prices surging, stock markets climbing, and a feverish hunt for yield globally. Japan had kept rates at rock bottom after its late 90s ZIRP, zero interest rate policy, and by the early 2000s, the country was still mired in deflation. Japanese yen was cheap. This coincided with a voracious appetite among investors worldwide for higher returns, leading to a massive yen carry trade buildup. By 2007, the yen had weakened to around 125 yen per US dollar, reflecting investors heavily selling yen to buy higher yield assets. While it's hard to get exact figures, these trades aren't neatly reported on any single balance sheet. Some estimates put the scale of yen carry positions in the hundreds of billions of dollars by the eve of the 2008 global financial crisis. In other words, a vast pool of borrowed yen was fueling asset purchases worldwide, from US subprime mortgage bonds to European stocks and emerging market loans. It was a hidden accelerant behind the bubble-like asset inflation of that era. However, just as dark matter in space is only obvious when something disturbs it, the yen carry trade's presence became dramatically evident when the bubble began to burst. In 2007 to 2008, as cracks formed in the global financial system, risk sentiment flipped. The seemingly endless appetite for risk gave way to a panicked flight to safety. And one of the safest havens? The Japanese yen. Investors who had bet against the yen suddenly rushed to buy yen back, either to close their carry trade positions or simply as a safe store of value. This caused a vicious feedback loop. As global markets tumbled, carry traders dumped their risky assets and repatriated funds into yen, driving the yen's value sharply higher, which in turn made remaining carry trades even more unprofitable, forcing more liquidation. The scale of this unwinding during the 2008 meltdown was stunning. The dollar-yen exchange rate, which had been around 120 to 125 yen per US dollar in mid-2007, plunged to about 87 yen per US dollar by late 2008. That's roughly a 30% appreciation of the yen in a matter of months, an enormous move for a major currency. For context, a year's worth of interest differential gains, maybe 5 to 10%, was wiped out in days by the exchange rate swing. Anyone in a yen carry trade saw their profits evaporate and potentially turn into painful losses. The rapid unwinding of the yen carry trade didn't cause the global financial crisis. That root cause was subprime mortgages and banking leverage, but it poured fuel on the fire. As one retrospective analysis noted, the yen carry trade's collapse worsened the 2008 global market meltdown. The forced unwinding contributed to the extreme volatility. When the yen surged and carry traders ran for cover, it added extra downward pressure on stock and commodity prices worldwide. Japan itself was not spared from this whiplash. The yen's spike hammered Japan's export-heavy economy. Suddenly, Japanese goods were much more expensive overseas, just as global demand was cratering. In fact, during the 2008 crisis, Japan's economy suffered the worst contraction among G7 nations. A strong yen was the last thing Japan needed in a recession, yet that's precisely what the carry trade unwind delivered. Fast forward to the 2010s. The yen carry trade went through lulls and revivals. In the early 2010s, the yen actually strengthened to record highs, around 75 to 80 yen per US dollar by 2011, as a result of global risk aversion and Japan's own economic woes. But then came a new chapter: Abenomics. Starting in 2013, Prime Minister Shinzo Abe and the BOJ launched aggressive easing, QQE, quantitative and qualitative easing, aiming to finally break deflation. The BOJ flooded the market with yen, and the currency began a steep decline from 2013 onward. By 2015, the yen had weakened significantly, and Japan was again a premier source of cheap funding. This re-energized the carry trade, now not just through banks, but also via algorithmic funds and global investors seeing an easy play. Observers noted that the yen carry trade in the 2013 to 2019 period kicked off in a big way, since US rates started rising. The Federal Reserve hiked rates in the late 2010s, while Japan stayed ultra-loose. The interest rate divergence was back, and so was the carry. Japanese cash flowed into higher-yield corporate bonds, emerging market debt, and equities worldwide. By 2022 to 2023, the yen carry trade arguably reached new heights. Some called it gargantuan. Why? Because the divergence hit an extreme. The US Federal Reserve hiked US interest rates from near zero to over 5% in 2022-23 to fight inflation, while the BOJ still pegged its short-term rate around minus 0.1% and capped long-term yields. The result? A massive 5% plus interest gap between yen and dollar yields. The yen also plunged in value during this time, at one point losing over 20% against the dollar in 2022 alone, making yen borrowing even more attractive. Traders could borrow yen practically for free and buy US treasuries, earning a hefty yield, or invest in Indian or Indonesian bonds, or tech stocks, almost anything offering higher returns. By mid-2023, yen-funded trades had quietly permeated many corners of global markets. It was like an ocean current, subtly lifting asset prices. Some market commentators even suggested that the rally in US tech stocks and crypto in 2023 was partly juiced by yen-funded liquidity, though that's hard to prove definitively. What's clear is that Japanese institutions and individuals alike were pouring money abroad. Japan's foreign portfolio investment hit record highs. Trillions of yen were sluicing into global assets, often unhedged, in pursuit of yield. This brings us full circle to 2024, the episode we opened with. After years of easy money, inflation started creeping up in Japan, for once. By mid-2023 into 2024, prices were rising enough that the BOJ began hinting it might finally tighten policy. In late July 2024, in a surprise move, the BOJ adjusted its yield curve control and nudged interest rates slightly higher. That tiny policy tweak, raising a benchmark rate to 0.25% from essentially 0%. And some tough talk about possible further hikes sent a shock through the complacent ranks of carry traders. The yen suddenly reversed its long decline and started strengthening fast. In the first week of August 2024, as mentioned, the yen's spike triggered a rapid unwind of yen-funded trades across the world. It was like a mini replay of 2008, though far more contained. Stocks dipped sharply, especially sectors that had benefited from abundant cheap liquidity. Tech stocks and even cryptocurrencies, some of the riskiest, most leveraged assets, wobbled as that tide of cheap yen receded. One analysis noted that the most dramatic drops were seen in areas like US momentum stocks and crypto, which hardly the reaction investors would normally expect, suggesting the yen carry trade had been quietly propping them up. Within days, Japanese officials scrambled to calm markets. A BOJ deputy governor publicly reassured that the bank will not raise rates further if there is market turmoil, trying to put the genie back in the bottle. This succeeded in stemming the yen's rise for the moment. The yen gave back some gains and stock markets rebounded by mid-August 2024. Yet, the episode was a stark warning. The yen carry trade had grown into a huge, invisible bubble maker, and even the smallest pinprick from the BOJ could send shockwaves through global markets. Like a finely tuned orchestra, the world's asset prices had been marching to the quiet drumbeat of the BOJ's zero-rate policy. Change that tune, and the dancers can stumble. Why does all this matter beyond the esoterica of currency trades? Because the yen carry trade affects us all. It's a key part of the plumbing of global finance. Think of the yen carry trade as a giant siphon, drawing money from where it's cheap, Japan, and spraying it into asset markets worldwide. When that spray is steady, it pushes up asset prices, compresses yields, and often suppresses volatility. It's one reason interest rates on things like US or Australian bonds may have been lower than they otherwise would. Japanese demand kept yields down. It's one reason stock markets had extra fuel. Cheap leverage from Japan found its way into equities. In good times, this extra liquidity can reinforce optimism. A virtuous cycle of rising prices begetting more risk-taking. However, this comes at a cost. It can make bubbles bigger. Former U.S. Federal Reserve Chairman Ben Bernanke once referred to a global savings glut keeping rates low. In a similar vein, one could argue there has been a global carry glut, an excess of cheap borrowed yen sloshing around. The Economist back in 2007 presciently warned that the yen carry trade was inflating asset price bubbles across the world. When Japanese housewives can influence the South African rand's value from their kitchen, and when a minor tweak in Tokyo's policy can cause a flash crash in New York, it's clear we're dealing with a deeply interconnected system. One could call the yen carry trade financial dark matter. Just as dark matter in astrophysics is invisible, yet holds galaxies together with its gravity, the yen carry trade is largely unseen. Few headlines scream, "Yen carry trade flows today." Yet it quietly holds up markets. Until it suddenly doesn't. Importantly, like dark matter, it's hard to measure directly. Even experts can only estimate the size of carry trade positions. A Reuters analysis in 2024 noted, "No one is quite sure how large the yen carry trade truly is." One rough proxy was the short-term external loans by Japanese banks, about $350 billion, which could be tied to yen-funded trades. But that might vastly understate things, since it doesn't count positions taken by global hedge funds or the trillions of yen Japanese investors have plowed into longer-term foreign investments. Furthermore, leverage, through derivatives, currency forwards, etc., can amplify the real exposure beyond what simple loan data show. In short, we often only see the carry trade's footprints after the fact, when a sudden move in the yen or a crisis forces it to unwind. For other countries, the yen carry trade can be a double-edged sword. On one hand, capital inflows from Japanese investors can be beneficial. They finance government deficits, e.g. foreigners buying Indonesian or Mexican bonds, buoy stock markets, and sometimes contribute to economic growth by lowering financing costs. Many emerging economies have welcomed global investors, including Japanese, buying their high-yield bonds. It's a source of funding. Even developed markets like Australia benefited. Japanese demand for Aussie dollar assets helped keep Australian interest rates relatively low and supported the currency during boom times. On the other hand, these flows can create a false sense of security. They can lead to currency overvaluation and asset bubbles that aren't supported by local economic fundamentals. And if the tide turns, say Japan's rates rise or a global shock sends investors rushing home, those countries can see abrupt outflows. The result might be a sudden asset price collapse or currency crisis. For instance, some analysts have speculated, what happens if Japanese yields rise enough that Japanese institutions sell their US treasuries and other foreign holdings en masse to invest back home? It could send US bond yields higher and weaken currencies like the dollar or Australian dollar as money sucks back to Japan. In 2023 to 2025, we've started to see hints of this. As Japan signals tightening, there's concern that the loud sucking sound could be global liquidity draining out, back to Tokyo. In ASEAN countries, economists have been weighing whether they can weather a potential yen carry trade reversal. Essentially, are their financial systems resilient if Japanese capital pulls back? In global forums, Japanese officials have often faced questions and sometimes complaints about the yen carry trade's impact. Interestingly, Japanese policymakers for years took a sanguine view of it. As long as it reflected market choices and didn't destabilize the yen too much, they were mostly hands-off. After all, with Japan's economy sluggish, who could blame Japanese investors for seeking yield abroad? However, their tune changes when the carry trade threatens to disrupt Japan's own currency too sharply. We saw multiple direct interventions by Japan in 2022 and 2023 to prop up a free-falling yen. In effect, Japan was fine with exporting capital, until the resulting yen weakness became too extreme, fueling import inflation at home. It's a delicate balance. Not everyone is convinced that the yen carry trade is an all-powerful boogeyman. Skeptics offer a few counterpoints worth considering. First, they argue that global bubbles have multiple causes, and low Japanese rates are just one factor. The US housing bubble, for example, had a lot to do with US interest rates, lax regulation, and financial engineering, not only yen carry trades. Similarly, stock market bubbles often coincide with technological hype cycles or corporate earnings growth. In this view, the yen carry trade amplifies trends, but doesn't create them from scratch. It's part of a broader ecosystem of easy money that includes US Federal Reserve policy, European banks, and more. For instance, during the 2020 to 2021 pandemic stimulus period, it wasn't Japanese money, but rather Fed-driven liquidity that arguably led the charge in inflating asset prices. So, some say we shouldn't overstate the yen carry trade's role. It's important, yes, but it's one piece of a complex puzzle. Second, central banks today are more aware and better prepared to handle carry trade volatility than in the past. After the chaos of 2008, regulators beefed up surveillance of cross-border flows and bank exposures. Many emerging markets now maintain higher foreign exchange reserves and employ macro-prudential measures to guard against sudden outflows. As one analyst noted, compared to 2008, authorities today are more engaged in intervening in currency markets, which could mitigate the impact of carry trade unwinding. In other words, if a rush of yen appreciation starts destabilizing markets, we might see coordinated responses, like central banks cutting rates elsewhere, or Japan smoothing the currency moves with intervention. Indeed, when the yen spiked in 2024, the BOJ quickly communicated a dovish stance to calm the waters. And in previous episodes, e.g., 2011's yen surge post-Fukushima disaster, G7 finance ministers coordinated to stabilize the yen. This implies that while the carry trade can cause abrupt pain, global financial authorities won't be caught completely off guard. The safety nets are stronger, one hopes. Third, some analysts point out that Japan's own policy shifts may be very gradual. The BOJ has been ultra-dovish for so long that it will likely move cautiously to avoid economic harm at home. If Japan only raises rates slowly and modestly, the carry trade might unwind in an orderly fashion rather than a sudden crash. In late 2024, even after the BOJ's slight hawkish turn, the yen's value, while higher, was still weak by historical standards, hovering around 140 to 150 yen per USD, compared to 100 yen or stronger in earlier eras. This suggests the correction may have more to run, but perhaps over a period of years, not overnight. In fact, one prominent economist forecast in 2024 that the yen might revert to a fair value of around 115 yen per USD over the next 3 years, a significant strengthening, but not a disorderly one. If that gradual path holds, carry traders would have time to adjust their positions without a full-blown panic. That said, serious risks remain on the horizon. BOJ policy reversal. The biggest risk to the carry trade is the BOJ fully normalizing monetary policy. If Japan decisively ends its negative rate policy and raises rates meaningfully, the fundamental arithmetic of the carry trade flips. Japanese yen would no longer be the ultra-cheap funding it once was. Already, Japan ended its negative rate era by moving to a 0% to 0.1% range in late 2023, and there is talk of further hikes as inflation has perked up. A faster-than-expected tightening, for instance, if inflation in Japan surprises to the upside, could send the yen soaring and catch carry traders off guard. The proverbial carry trade party would truly be over. This scenario would test global markets' resilience. Remember that even a 0.25% tweak rattled stocks in 2024. A larger concerted BOJ tightening could trigger a much bigger unwinding of positions globally. Global inflation, or rate shifts. elsewhere. Another risk is if interest rate differentials narrow from the other side. Say the US Federal Reserve or European Central Bank cut their rates sharply, due to recession, while Japan holds steady or only inches up. In that case, the advantage of borrowing yen to invest in dollars diminishes. Some carry trades might unwind simply because the yield pickup shrinks. We could actually see the opposite flows. If, hypothetically, US rates fell below Japan's, investors might borrow dollars to invest in yen assets, a reversal known as the reverse carry trade. While that scenario isn't likely in the near term, the point is that changing macro conditions can rapidly alter the incentives for carry trades. Safe haven shock, geopolitical or financial crisis. Perhaps the most unpredictable risk is a major geopolitical or financial shock that sends everyone fleeing to safe havens. The yen, famously, is a safe haven currency. In times of global panic, be it a war, a pandemic resurgence, or a severe credit crisis, the yen tends to strengthen as investors around the world seek stability. This happened in past episodes like the 1997 Asian crisis, 2008 crisis, and briefly in early 2020, COVID's onset, and could happen again. If something sparks a sudden risk-off wave, yen-funded carry positions would implode as the yen spikes. The paradox is that what was once the cheap funding currency becomes the refuge. For carry traders, that is the nightmare scenario. Not only are the risky assets falling in value, but the yen loan they owe is surging in value simultaneously. A double hit. Such an unwind can be self-reinforcing and painful, as we saw. Geopolitical instability, for example an expansion of conflict in Eastern Europe or East Asia, could trigger this kind of chain reaction, even if unrelated to economics. The dark matter could swiftly turn into dark storm clouds. Japan's economic health. There's also the chance that Japan's own economic trajectory surprises in either direction. If Japan falls back into deep deflation and growth stagnation, the BOJ might keep money ultra-cheap indefinitely, encouraging even more carry trade build-up, and thus future bubbles. Conversely, if Japan finally achieves sustained growth and inflation, it would transform the yen from a funding currency to perhaps an investment currency. That could fundamentally alter global capital flows in ways we haven't seen in a generation. Either scenario would be a regime change from the status quo, and big regime changes tend to be bumpy. In short, while many are aware of the risks and prepare for them, the yen carry trade remains a precariously balanced phenomenon. It's like a huge spring that's been coiled by years of low rates, compressing more and more, and one wonders how much energy will release when that spring uncoils.